they had the judgment, they had their judgment, and didn't have to say, but hang on, this reporting said she's pro-life in an interview with Shareholder, right? And they couldn't find the reporting. And they said, no, they said, the manager report. So they brought the reporting to the judge. So they hang on. So they rescinded the judgment. They taken it back. So of 40 years, they never took it back. They'll throw it in the whole ruling was based on from the absolutely, but that's the problem.
Hello, Piet.
Hi there, Alec. How are you?
Well, I get.
All right. Can you hear me clearly?
I can't hear you. Okay, I got to put my headphones on. then I'll hear you. Hang on. Are you worried about the camera? Okay, not to worry. Not to worry.
Can you hear me now, Alec?
I know how the camera works. Hello, Piet.
Yes. Can you hear me?
Hello, Piet.
Yes.
Can you hear me?
Yeah. I can hear you. Yeah.
There we go. All right. Okay.
Good.
All good.
Excellent.
Okay. All good. And you sound good.
Is my volume right and sound right?
Sound absolutely fine.
With
I'm just going to try and fix the
microphone.
camera. Great. Terrific. Let me get in here quickly. This is mute. That was mute was off. Camera. Often when you have a problem, just do that. Switch it off, switch it on. Hubba, hubba, hubba. Otherwise, what we'll do is very simple. Yeah, we'll just use that. Okay, seems to be better. No, it's not working. Still not working. Okay. Marcus is in the room. Okay. But don't you worry. I'll just take this out. Oh. Take the wrong one out. Okay, where are you?
Hi, Mark. How are you?
Hello, Piet. Good. How are you? Long time.
All right. Thanks. Yeah. I haven't seen you for a while, eh?
Yeah, I think the last time was in your offices in Cape Town.
Exactly. Yeah. That's right. Yeah. It's been a long road for you, eh?
Cruel and unusual punishment.
Yeah. Yeah. I can't say I don't envy you, but I have to say I take my hat off you. I think you've done a good job there.
Oh, thank you. I think it's better than the alternative, certainly.
Yes, much better. Much better.
Update. Damn. Okay, well, we don't really need to have me. No camera found, camera off. That's why. It'll be fine, yeah. Hey, why's camera off? There we go. Right, save it.
Alec, my camera isn't working today.
Well, only have the one.
Yeah, sorry, just
Okay, and
then just remember we doing the market report at 6.
You plug what in? Oh, okay, I'll do that. Don't you worry. You do the other one. Okay, this is late, guys. We mustn't be this late. Please, 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 please. In future, in studio, 25 past. Okay? Seriously, this is bullshit. Right, away we go. Hello, Mark. Nice to see you.
Nice to see you too.
Great, man. Thanks for joining us after a long day. Okay, we're standing by and we're going on air in about 30 seconds.
Stand by. Business Power Hour starts in 25 seconds. "15 seconds. 10 seconds.
'The BizNews Power Hour'.
Welcome to the BizNews Power Hour, where we give you the rational perspective on business news that matters. We've got two companies that are very much in the news in our spotlight tonight. We'll be talking to Mark Sardi, Chief Executive of Ascendis Health, in just a moment. And then a little later in the program, David Hurwitz, the Chief Executive of Transaction Capital. You've been following both the stories, Justin. Ascendis Health recapitalization, a company in trouble, a transaction capital, a company that's flying. So it's interesting to contrast the two.
Two different companies at different ends of the spectrum. I do think Mark Sardi has done an incredible job to get the business to the presentation today. It looked for all money that it was going to go into business rescue, and shareholders were going to be left with nothing. And then in transaction capital's case, good results, solid results. But the most interesting part is that they're looking to increase their stake in WeBuyCars from 50% to 75%.
Yeah, well, from just under 50%, 49.9. Remember, we were asking them about that. So it's a big move. But we got Mark Sardi with us in our virtual studio alongside the inimitable, one and only, Piet Viljoen. Lovely to have you with us, Piet.
Nice to be here. Thanks, Alec.
Do you know much about those two companies? I know you know a lot about transaction capital, but Ascendis, in fact, I think both of them are very much on your radar.
They're both in my fund. I own both shares, yes.
And before we bring Mark in, Justin's view that he's turned this or made it possible for shareholders to get something out when they might have got nothing out. Do you agree?
Yeah, getting nothing out was a realistic probability for shareholders. So I think Mark and his team have done a fantastic job. A debt workout is never easy. Those negotiations must have been tough. I can't even say I would have wanted to be a fly in the wall, because I think they're too tough for that even. The debt guys, the upside they get is the money they put in. There's no further upside. So they'll try and eke out every last cent. So those are really, really tough negotiations. And I think where shareholders have ended up today is a good outcome.
At the BizNews conference, you had bundles of companies you told us about that could go bust or actually could come right. Yeah, wasn't Ascendis one of them? Ascendis
was one of them. It's my bundle of twigs analogy I use. You buy a bundle of these companies that, from an equity shareholder's point of view, they could break and snap and be worthless. But if you buy enough of them and put them together and bundle them together, you actually come up with something quite strong. And so far, it's working out very well. Ascendis being one of them, and there's a couple others out there in the market as well.
Mark, I know your background from Nedbank Capital, where you were a top banker. Having once spent some time in a bank, I know that it's quite tempting to stay in a bank. They pay you well, they look after you well, there are lots of share options, and yet you went off into a different career. You didn't stick around at Nedbank. You've done quite a few interesting assignments before this one, but all of them seem to be true with CFO, working at Cipla, House of Busby. They seem to be pretty stable, nice jobs, and then you go and jump into the fire with Ascendis. When you arrived there in 2019, was already in deep trouble. Why did you decide to do that? What was the motivator?
So, Alec, I think, when you look at it from outside in, the balance sheet was a disaster. There's no question. So bad balance sheet, tick. But fundamentally, the underlying businesses, the vast majority were good. There's one dreadful acquisition called Cytec, which was the sports nutrition business. But in large part, good businesses. I just think, the previous regime paid too much for them and structured them with too much debt. And as you know, when the music stops, and notwithstanding, a solid set of underlying results to December, when your debt grows by your market cap every 6 months, that is unsustainable. And so, to your attraction, I think when you do have good businesses, there is always the prospect of salvaging something as long as the debt doesn't run away. So the secret is, I think, to cauterize the wound as quickly as you can.
On the other hand, if it had gone pear-shaped, it wouldn't have done your career much good.
I know, I can safely say it wouldn't. So it's either blind faith or massive stupidity. But I think, maybe fortune favors the brave / foolish on this one.
I'm really getting at it being a calculated risk rather than idiocy. Piet, you don't have somebody with Mark's pedigree jumping into a situation which is unrescuable. Did that play much part in your decision to put Ascendis into your bundle of twigs?
Very much so. I mean, again, the underlying business, as Mark points out, were mostly very good businesses. The problem was the debt. And if you're going to work that situation out, then I think there might, and as Mark has shown now, there is something left for shareholders, something left left to salvage for them, and there's value, and that's so you can't just buy any business at too much debt. You need to look at the underlying operating entity to see whether they can actually stand on their own 2 feet. And I think I'm sure that's what Mark did before he even took the job on day one, that he looked at the business and saw that there was some good stuff there.
Now, my colleague, Justin Rowe Roberts, follows Twitter, and he follows the conversation around many of the stocks, of which Ascendis has been in the ascendancy, hasn't it, Justin?
Exactly. I mean, the Ascendis activist investors have done a great thing. I mean, activism investing is so huge in the US, and it often works. You look at guys like Bill Ackman, what he does with Perishing Square. He goes into businesses, takes a firm stance, gets board seats, and this is what we're seeing with the Ascendis activists. And let's hope it can continue to other businesses that might find themselves in similar situations.
So what did they make of the decision today? And Mark will take us through it in a moment. But the big announcement that came out of Ascendis, which seems to, the drowning swimmer now appears to be on the shore.
Exactly. So Harry Smith, who's the representative of activists, the Ascendis activists, who will be on the show later, he was happy with the announcement. He thought it was fair. And I guess we'll have to unpack in greater detail when he's on the show in about half an hour.
But from your side, Mark, how long did it take to negotiate this? Given that you've been with the company since late 2019, you weren't there for very long when you said that this business needs recapitalizing. You had the banks at your throat in June last year. How long did it take to work what you've announced today? And what exactly have you announced today in simple terms? Yeah.
So Alex, we tried a number of different ways to, you needed to basically write a check for 400 million euros, which was the capital plus the interest. So we looked at leveraging some of the operating companies, the good businesses. We looked at selling certain businesses, putting in a convertible bond, doing a take private. We looked at merging certain of the underlying entities, gearing up the merged entity, keeping an equity stub. But all of those, if you can't come up, and this was a learning for me, with the full check plus the interest, you don't get the right to play. And so while these things might have been good at the edges and good for shareholders, unless you can say, banks, here's your capital plus interest, they say, go and think again. I think where things started to sort of harden is with the arrival of Letter One and Blantyre, who said, look, this path that the lenders have put you on is not a sustainable one, because what they've said is you have to sell your way out of this problem. So sell all the crown jewels, sell whatever you can. And as you and I both know, when you're selling something with sort of the fire sale, sign above your head, full value extraction is almost impossible. So end of January, they said, we don't believe this is going to be in the best interest of shareholders. We are going to not allow you to sell anything else. And we think your number one priority now has to be to renegotiate the terms of the debt. And what it's done, it says, let's have a look at what our debt looks like at the end of August. And it's around 447 million euros. And then say, okay, what are we giving you in exchange for that 447 million euros? We're giving you Remedica, which is a 40 million EBITDA euro business in Cyprus. We're giving you Sunway, which is a 12 to 14 million EBITDA business in Romania. We're giving you Pharma Leader, which is about a 3 million EBITDA business. And we are giving you the net proceeds from the sale of our South African animal health business, our biosciences business, and the respiratory care Africa business, which is the one that played really well into COVID, the ventilation and the nasal high flow devices. The sum of those assets and cash flows are used to discharge that 447 million obligation. Then what we're left with is 3 South African assets. One is a pharma business, a consumer business, and a medical devices business, excluding RCA. Now, interestingly, each of those 3 businesses, I think, would be attractive to a number of potential players in the market. So I don't discount a lot of inbound interest on those remaining assets between now and the vote and perhaps beyond.
How did you make a decision on what to sell? Was it forced on you, or you mentioned earlier that the banks perhaps wanted the crown jewels? How did you come to the decision that these are the assets that we want to sell? And I'm asking this because Tongaat went through something similar, where they've offloaded their starch division, which in a way was a crown jewel.
Yeah. No, unfortunately, the crown jewels are always the ones that are easiest to sell because there's always a market for it. And also when your debt is a staggering, whatever it is, 7 billion rand, and your biggest asset and your most profitable one is the single biggest path to sort of reduction in debt, you almost have no optionality. The guys say, this is it. If you don't do it, bad things will happen. You will be in default on certain things. So that decision was largely taken out of our hands. But I do think, given the underlying performance in those assets, it allowed us to trade them away that at least preserved a bit more optionality for the South African businesses.
Piet, was it a good restructuring?
I think so. As Mark says, when you sit with these guys, you don't have a lot of choices, and I think where Shareholder landed up is a good place, because you're left with the South African businesses, which aren't bad business. They're in their own rights. They are decent businesses, and in other players' hands, they could be worth a lot of money. And the important thing is that the pressure is off. Ascendis is not a forced seller anymore. So now, you can sit back, take your time, and negotiate a good transaction, if there is one. I'm almost 100% sure there will be offers for these businesses, and you can negotiate decent prices for them. So I think it's for shareholders, being one, so I'm not unbiased, I think it's a fantastic deal.
Mark, I was listening to your presentation this morning with great intent. Afterwards, I had a look at the interim numbers and try to make some conclusions. I've got 2 questions. I do apologize. We tend to avoid technical questions, but I think these are very important in investors making informed decisions. What contribution of Respiratory Care Africa's, what does that contribute to normalized EBITDA of medical devices? And then what net debt remains in the worst case scenario of Pharma Leader?
Okay, so those are very good questions. And if I answer them, I give away material price sensitive information. So job well done on asking the right question. The challenge I've got is inside that medical devices business, RCA has had a 1 in a 100 year event, turbocharging those earnings. What I will say is we're in the latter stages of selling that business. So we will be releasing an announcement which sets out the numbers. I think when that happens, there'll be enough breadcrumbs to say, okay, what was RCA in that half year performance? So what's left? So that's I know exactly where you're going. So then that's the EBITDA for the remaining 3 businesses. Add that to consumer, add that to pharma, put a multiple on that, then subtract the debt, and then you get an equity value. And I think so I can't unfortunately answer that until we've either put the pro formas out in the circular or disclose some more information on RCA. But to your point around debt, there's one bucket that's hardwired. There's a 15 million euro equivalent, or 260 million rand, that will be a permanent day one facility. And then we will have a 20 million euro or 350 million rand working capital facility. Now, as you know, working capital facilities aren't permanent debt. They're there just to get you through the trough of your working capital cycle. So that will go up and down. But the permanent debt there is, let's say, 15 million euros. It costs around 10% there or thereabouts, and it's all in PIK. That's important because PIK is non-cash pay. And I've said, whatever we do in the next 18 months, we need to make sure we've got sufficient working capital and cash flow to either optimize these businesses, to make them ready for sale, or to get them to a point where they can justify a residual listing. So I hope that gives you some of the breadcrumbs, but unfortunately, you won't be able to piece the puzzle together until you back out RCA.
And now to bring back our audience who've actually switched off for listening to this intense detail, we did see a share price up nearly 10% today. So clearly the announcement was welcomed, but it's a heck of a long way from where the shares were 2017, 2018. I asked the same question of Stefan Koller at EOH, who in some ways is similar. You didn't have the fraud that he had, but where we had EOH at a exponentially higher share price than they are today. For those shareholders who bought 2016, 17, 18, should they just get to understand that the business is not going to be worth those kind of prices, or do you have a path to get back to that level?
Alec, I don't think there's any world in which you'll get back to that level for a number of reasons. One, we sold a business called Cytec, and just as an example to underscore what happens if you make a bad acquisition. We paid 170 million euros for this business. We sold it for 5. Ooh. The reason we sold it for 5 is if we hadn't, we would have to put another 15 million in just to keep it going. So if you take the difference between 170 and 5 and multiply it by 20, that's 3 billion rand. Divide that by the number of shares, that's 6 rand a share there, that's gone forever. And the debt stays behind. So, you've got these permanent downward resets of value from some unfortunate acquisitions along the way. So I don't see that happening. I think your next best actionable alternative from where we are now is business rescue. And that scenario, shareholders, will almost certainly get 0. And so I think this, at the very least, creates some optionality and some time for us to go after the things that matter in the underlying businesses and to make sure that they're attractive for, potential third-party investors.
Are you sitting in the dark there, Mark? Because in our virtual studio, it's very dark. We can hardly see you now, and you've been kind of fading away.
Would you mind if I turn the lights on?
Oh, I'd love you to turn the lights on. It is winter now.
Sorry.
But while you're busy turning the lights on, wasn't there some speculation? We'll have Mark nice and clean. Fantastic, thank you. Was there some speculation that Ascendis was going into business rescue, and then before today's announcement, the share price suddenly picked up again?
Yeah, I think that was on Monday, Alec, if I can remember correctly. I think where it all goes wrong in these kind of things, I don't think it's Mark's issue and stuff. So many different businesses, the investment banks, other corporate advisors are involved in the transaction. So I think people speak, and then when that news gets out a little bit early, people climb on. I don't know, Mark, what's your take?
So all I can think is it's a relief rally because, to your earlier question, Justin, there's no tangible set of data for you yet to make up your mind on whether this is a fantastic deal, a good deal. It's better than naught for sure, but you really have no way of calibrating just how good or bad or indifferent it is. So I don't know if it's buying on, speculation, selling on fact, but I do think there's some degree of relief in the share price rally.
I'm sure the guys at Famous Brands feel your pain, because what happened with your 170 million euro acquisition is a little bit like what happened with their burger franchise that they bought in the UK, and that's also gone now. Gourmet Burger, was it Gourmet Burger King or something along those lines? Piet, how do you know as an investor when management, it's not Mark's fault because he's coming to fix things, but how do you know when management is overreaching, like in that case of the 170 million euro here, or the burger franchise that Famous Brands bought?
Well, there's always a couple of clues. The first one is offshore acquisitions. Most companies, South African companies who make offshore acquisitions, just waste the money. They have this compelling urge to go offshore and buy stuff that nobody else wants at a very high price. And it just happens time and time again. So when somebody goes offshore and makes an acquisition, that's your first clue. The second clue is when you make a lot of acquisitions in a short space of time. When you have like deal frenzy happening, I think that's another clue. And the third one is when you're financing a lot of the deals with debt. I think that's your third clue. And, it happened with Steinhoff. Forget about the fraud, just the strategy that Steinhoff followed of massive acquisitions funded with debt. It creates problems after all. Lots of companies have done that. Woolworths in Australia, buying, it just happens. And those are and then you just stay away and you wait for the dust to settle. And sometimes it takes a long time. Ascendis, the dust has been settling now for a long time before we decided to get involved. So, it's just, things take time and one has to be patient.
Gourmet Burger Kitchen, it's called. And it's a pretty crummy place. I tried it a couple of times, being somebody who loves burgers, and it really wasn't gourmet by any means. Anyway, so Mark, that I'm sure you would agree with Piet, having had felt the sharp end of what the decisions that were made some time ago, that when you see a South African company buying offshore, just be very careful.
Agreed. And I think, I think the one that has probably got it right is Foschini, but that is the exception that probably, proves the rule. But I think, you can't underestimate going offshore, yes, but then doing too many things at the same time. Because the problem is your due diligence hurdle just drops. You're shooting at anything that moves. I'm not saying that is the case, but it is hard to keep management focused on the underlying businesses when there's all this distraction going on.
Thanks very much to Mark Sardi, the Chief Executive of Ascendis Health. And I'm sure there are many people in that company who are feeling, sleeping a lot easier tonight after the decision by the banks and the executives of Ascendis Health to come to an agreement which will see the company continuing into the future. You're listening to the BizNews Power Hour, brought to you by the team at biznews.com. Well, from a company that struggled a lot to one that's been flying high, David Hurwitz is the Chief Executive of Transaction Capital. Good to have you on the program, David, on a day when you released your financial results. And, well, however you want to look at it, they're strong. We're not going to go through the individual numbers, but what we are going to ask you about is We Buy Cars. Now, we've spoken to you about We Buy Cars. It looks like it was a great acquisition. Now you're taking it above 50% to just under 75%. You did say last time we spoke to you that you were quite keen to do this at some point, but this does appear to be a little earlier than most of us expected.
Yeah, it is earlier than I think than the market expected. There was a structure in place which from years 1 to year 3, if certain conditions were met, we could start looking at, they could start selling more shares to us, quite frankly. I think what's happened is that we've been very, very impressed with the quality of the management. We've been very, very impressed with how robust this business is. And all in all, probably most importantly, we are very excited about the sector. The used vehicle sector internationally has boomed over the last few years. I think COVID has even given it a bit of a tailwind. More people are trading down and buying second-hand cars instead of new cars due to disposable income constraints and also prices of new cars going up. And then the next thing is that cars are kind of the last large asset class that needs to fall into e-commerce. So there's a big e-commerce and online trade happening, and that made us very excited. I think what made the founders who are selling, the private equity team who are selling to us, kind of what brought them along was that they're excited about what TC can do as far as the finance and the insurance element of this business goes. So for these reasons, this has been accelerated.
David, did I read the numbers correctly? But the growth in March 2021 in We Buy Cars, and the turnover is a multiple of what it was pre-COVID. Has it really expanded that rapidly, or did I read the wrong numbers?
No, so if you take a look at volumes, I mean, pre-COVID, We Buy Cars was both buying and selling roughly about 5,000 cars a month. And if you take a look at where we are now, in certain months we've been hitting about 8,000. So, that is significant growth. And it's also come with a greater penetration of earning finance and insurance revenue, with margins staying stable. So, this business really is growing quickly. We now sell about 40% of all of our cars online, which really helps significantly in terms of turning your stock quicker. So, with the similar infrastructure, because of this online capability, you don't have to invest into bricks and mortar. So this is all, really, really driving the growth. And, headline earnings was up by 35%, and revenues up by 32%. So it really is a fantastic opportunity for us.
Piet Viljoen is with us as well, one of your fans, as they told us at the BizNews Investment Conference. Piet, the price that is being paid for the additional 25% in We Buy Cars. Now, you said the first 49.9% was at an extremely good level. Do you feel the same way about the additional quarter?
Yeah, very much so. I think the initial 49% was, if you look at...
Is that for Piet or for me?
Sorry, it was for Piet, but Piet seems to have muted himself, I think.
No, I think I'm back. I should be back. Can you hear me now?
Indeed, we got you now, yeah.
But David can answer that. I mean, I'm more than happy for David to answer.
No, I want to know from you, Dave. I want to know.
Well, maybe if I could interject, is that we only issued a cautionary, so we haven't disclosed anything around the price yet, and maybe that's why it's being a bit tongue in cheek. we bought the first 49.9 at a P of about 10.5. And I can't talk about the price. It's still under negotiation, but certainly we will have to pay a premium for control. I can say that.
Okay, well, that's a pity. But Piet, generally on the results and on that acquisition, looking back at it?
So I think it's a great acquisition for both parties, and that's always a hallmark of a good acquisition if both parties win. So I think We Buy Cars got a fantastic partner, and as David points out, F&I, finance and insurance, is a key part of that business, and if they can grow that faster, that'll add a lot of value. But if you just compare We Buy Cars valuation or the price that Transaction Capital paid for it, for a very similar company in the US called Carvana, which is also moving second-hand car sales online. Carvana trades, is a listed company, it doesn't make money, it makes losses still, but it trades at 3.5 times sales, enterprise value to sales. So the multiple that Transaction Capital paid for We Buy Cars is a quarter of that. For a business that actually makes money, yeah. So I think it's really good.
When I was having a look at the three divisions that you have, David, the one that obviously the question that begs to be asked is, now that Tito Mboweni has disclosed that all of the taxi owners are only paying a combined 5 million rand a year in tax, their margins, presumably, once the tax man gets his claws into them, are going to come under some pressure. Is that going to affect SA Taxi, your business, which really is the biggest part and about a half of the profits that you generate?
Yeah, I saw that article that was released yesterday. I think it's only one data point. I mean, certainly if tax flows out, then that does put affordability pressure on the industry. Where we are right now is that we've seen collections recover to about 95% or so of pre-COVID levels, and our book is performing really well. So we're comfortable with that, and we don't see significant credit risk in our book. On this tax question, it really is only one data point, and I think there's a long way to go in this debate. First of all, the industry pays over 7 billion rands worth of fuel levies. And it pays over 1 billion rand worth of that if you just calculate the vehicles that it buys, and these vehicles are income producing. So I'm not sure if it's really fair to be charging VAT to these, to the industry. There should be some credits. So it does contribute over 8 billion rands to the fiscus for a start. I think the second thing is that the industry, about 3/4 of South Africans move around in public transport, and minibus taxi is 84% of that of public transport in South Africa. Bus and train are subsidised. Minibus taxi receives no subsidy. So that's a debate that also needs to be held. I think it would be pretty unfair of government to come after the industry, who is completely privatised and doing a public service, and hunt them down for tax when they're not giving them any subsidy. So I think there are a lot of things. I'm not saying that the industry shouldn't pay tax, but I'm saying they certainly aren't the pariahs that people like to make them out to be. And I think the government needs to take a full view on the industry before making moves like that. So let's see where it goes.
Without being impolite, you are certainly talking your book, and certainly the book of your customers. But we'll see how that thing plays out. It was very surprising to hear that Tito wants to try and get money out of the taxi industry. They can't do anything else, government, to the taxi industry. So now they want to get money out of them in tax as well. That it could be snowing in Johannesburg. But just to close off with you, David, your debt collection service, the TCRS, the big part of your business, I was astonished to see that you reckon 40% of 27 million credit active South African consumers have got what you call impaired credit records. So in other words, they're blacklisted. Is that an accurate number? That wouldn't be blacklisted. That would be they're in arrears. So they're behind on their payments. They may not have been listed, but they will certainly be behind. And that's a number that's been quite consistent I've been tracking that for about 4 or 5 years now. So yes, that's pretty consistent. And through COVID, has that risen much?
It's actually gone down slightly, and I think it's because banks haven't been actually collecting as aggressively as they normally would have. So it's actually resulted because banks haven't asked for the money, hence you don't fall into arrears.
David Hurwitz is the Chief Executive of Transaction Capital. Well, Piet, it's been a high flyer on the JSE. It's done a really good deal with We Buy Cars and continuing to do so now. Is it a stock that you have in your portfolio?
It is. Yeah, it is. On the face of it, it doesn't look like a value stock. It's got a high PE ratio, but PE ratios are what they are. I think the value in Transaction Capital sits with the platform they've built and the growth prospects for the business, the different platforms they have there. I think all three of them have fantastic growth prospects, and I don't think one is paying too much for them, even at these prices.
And they've built the platform, as you say, so that they're going to take advantage of the digital or the move towards digital. Justin, are you happy with what you're seeing from Transaction Capital?
I am happy. As Piet's saying, I mean, if you have to look at it on a relative valuation basis, PEs, PS, all that boring stuff, it's not that attractive now, but it's a great business. There's vertical integration between the taxi business and now We Buy Cars. But Piet, something that I want to, that caught my eye now when you were speaking, you said that it was a great deal for both parties. So I watched that presentation of yours where you broke down the global peers and how cheap We Buy Cars was relative to the global peers.
Yeah.
How was that deal good for both parties? Yes, Transaction Capital got a bargain, getting 50% for 1.8 billion. But how did the original owners get a good deal if it was such a good acquisition and so undervalued?
Well, they still own 50% up to now, and own 25%. So whatever benefits the transaction brings to the business, they will share in those benefits. And from that point of view, it's a good deal. And I think the business under the umbrella of We Buy Cars can probably achieve a lot more than it can on its own. So you give up a little bit now to get a lot more later on.
It's a point that I remember a very smart investor who loves to keep a low profile. When he came to me with the internet company that I started, he said to me, list it and I'll take you 5 years into the future in 5 months by giving you the capital that'll enable you to grow. So it was a win-win for everybody in that case. Yeah. And those are the great deals when a founder stays involved, remains excited about it. And I can see, I relate exactly to what you said there, Piet. Before we go on to the news headlines of the day, and we're actually shifting our show around a little bit. We have a flash briefing, which we usually start the show with at 5:30. We're going to give you like a news bulletin at 6 o'clock and then go through the markets. Won't you just think a little, Piet, about what's going on in the US? We see right now the Nasdaq's down 2%. The Dow continues to slide after a really bad day yesterday. It's down 1.25%. I'd love to get your views in just a moment. But first, let's hear from our editor-at-large, Jackie Cameron, with this flash briefing.
The COVID-19 pandemic has powered up South Africa's online retail sector. A new study that includes bank data reveals that the total growth for online retail in 2020 came to 66%. This brings the total of online retail to more than 30 billion rand. The study's lead, Worldwide Works MD Arthur Goldstuck, is quoted as saying that the most astonishing aspect of this total is that it is more than double the 14 billion rand reached in 2018 in just 2 years. South Africans are not vaccine hesitant. In fact, at least 7 in every 10 adults surveyed in the Coronavirus Rapid Mobile Survey would get a jab if it was available. The survey's principal researchers say that the youth and those with only a primary school education are more likely to be vaccine hesitant. So far, less than 420,000 healthcare workers have been vaccinated in South Africa. The opposition Democratic Alliance describes the slow rollout of vaccines, particularly among healthcare workers, as the greatest injustice. And it points out that the country is possibly on the brink of a third wave of infections, and other variants of the pandemic have been detected in the country. Dutch-listed technology investor Prosus plans to raise its stake in South African parent Naspers to nearly 50%. This will be in a share swap deal that will move part of its huge holding in China's Tencent to Amsterdam from Johannesburg. Naspers is Africa's biggest listed company because of its Tencent holding, but its shares trade at a steep discount to the value of its stake. US consumer inflation rose far more than expected in April to 4.2% year-on-year, with core inflation up at 3%. Standard chief economist Kevin Lings notes that US inflation could remain uncomfortably high for an extended period unsettling financial markets. His analysis shows that the risk of sustained higher inflation in the US has seldom been more extreme than is currently evident. I'm Jackie Cameron. That was your BizNews Flash Briefing. For more on those and the other big stories of the day, do visit biznewsradio.com.
BrightRock believes that with every change in life comes opportunity, and the markets aren't any different. The daily movements in the markets mean change for us all, sometimes small, sometimes big. This daily market report is made just for you by BrightRock, the first ever needs-matched life insurance that changes as your life changes. Here's Justin.
The JSE All Share Index was up at 67,400. Distel up 5% to 142 Rand as people start gearing up for the weekend on Hump Day. Prosus up 2.4%, whilst Naspers was down 1.6% as the index heavyweights announced further corporate action, which we'll unpack during the show. And Multi-Choice lost 6% to 120 Rand a share. In the currency markets, the Rand was flat against all the major currencies to 14 Rand 05 to the dollar, 19 Rand 81 to the pound, and 16 Rand 97 to the euro. Gold is low at $1,824 an ounce. Brent crude is up at $70 a barrel. And the premier cryptocurrency will put you back 780,000 Rand a Bitcoin.
Well, Piet, let's pick up on the US markets. Nasdaq down by 2% today, and it's really it's having a pretty torrid time in the last few days.
Yeah.
What are you making of this? Is it the long-awaited end of the upward swing, or just a healthy correction?
Well, first of all, who knows? I do think one should not place too much emphasis on daily moves in the market, because that is a random walk, as Bertrand Martial wrote about years and years ago. But I think behind what's happening specifically today is the fact that the inflation number for the US was released. It came out higher than expected. So I think the market is now starting to think about what high inflation might mean for valuations of different parts of the market. And I think what has been happening, for a few months now, is that long duration growth assets have been under relative pressure, at least the tech stocks and others, and shorter duration value type investments have been relative output. In fact, in absolute terms, they've done fantastically well, because their cash flows are generally right here up front right now, and they're not influenced as much by long-term interest rates. So I think there's a bit of there's a movement or a switch happening from growth to value, and I think that is only just started. I'm of the opinion that it has a long way to go still.
You've performed incredibly well by not being stuck in a deep value or a high growth area, by being flexible. Yeah. Are you moving your portfolio now to value stocks?
The portfolio has always been weighted towards value stocks. I mean, I am a value investor, but it does contain stocks like Transaction Capital, which we spoke about earlier, which is by no means a value situation, although I do think it's trading at less than the present value of its future cash flows, which means it's cheap. But yeah, I do think the ability to invest across the spectrum is quite a powerful one. And very few people, people generally get boxed into that, and they find it very hard to move. And I think that is one of the reasons why I think this move from growth to value will endure for quite a while, because I think there's a large body of investors out there which have been investing for more than a decade now in one direction. It's going to take time to swing them to the other direction, because you sort of get stuck in the way you do, which has been very successful, but you get stuck in that way, and it takes time to swing. So I think this is the start of a long-term switch out of growth and into value.
This market report was made just for you by BrightRock, the first ever needs-matched life insurance that changes as your life changes. You're listening to the BizNews Power Hour, brought to you by the team at biznews.com. Peter, I spent a productive 45 minutes this morning on a conference call with Bob van Dijk and Basil Skordos of Naspers / Prosus, with a decision that the group has made for Prosus to buy roughly half of the shares that are held by Naspers shareholders, and then to swap them over to Prosus. they're very confident that they're going to get, I think it's 45.4%, and it's going to make a lot of changes. We're going to play in a moment a highlight of a package that I put together, which is the package is about 15 minutes. This highlight's about 4 minutes. But before we go there, today, when the announcement came out, as the markets opened, Naspers and Prosus were both up 3%. As we've just heard from Justin, they finished the day in the negative. That's quite a big swing from being very positive about the deal. Sorry, did Naspers fall?
So Prosus was up 2.4%, whilst Naspers was down 1.6%. Nearly a 5% divergence. Why was that, Piet?
Thanks for I only heard the Naspers side. I didn't hear the Prosus side. So Prosus up, Naspers down. As Justin said, what's the story?
I'd probably make 3 comments about that. First of all, I don't understand the story. I have no idea what they're trying to do. And I think the market is still trying to figure it out, which shows in the price movements that Naspers is down and Prosus is up. I think the market's trying to figure out ways to arbitrage this, to play the game, because that's what Naspers is doing or Prosus is doing. They're playing a game, and the market's trying to figure out a way to play the game. The second thing I will say is that I don't know what management are doing, but they're spending a lot of time on these corporate structures where I think the time could probably be best spent elsewhere. And the third thing I would say is that Prosus was brought into creation in, I think, September of 2019. That's 2 years ago, almost 2 years ago. Since then, and that was their big attempt to start narrowing the discount. Since then, the discount has just widened, and it continues to widen. So the market is giving everything they do the thumbs down. And I'm not sure that they realize this yet. But those are the comments I would make.
What they did say today, because I posed very similar questions to the ones that you're talking about now, what they did say was that Prosus has a smaller discount, a much smaller discount. In the last year, Prosus is up 50%, Naspers is up 30%. And as a consequence, Naspers shareholders can get a benefit of an immediate benefit. They put the number at $10 billion by swapping their shares into Prosus. So that's the counter side. But let's listen to this clip, and I'm sure you'll have some comments afterwards. Well, it's been a year and a half since Naspers, the JSE's dominant listing, re-engineered the business by floating its new European subsidiary Prosus on the Amsterdam Stock Exchange. According to Chief Executive Bob van Dijk, the decision to do the float immediately unlocked $16 billion in value for Naspers shareholders. Today, the group announced another step in this project value unlock. Naspers shareholders are being offered to convert their Naspers shares into Prosus stock. Naspers shareholders will be entitled to tender all of their shares in this swap, but because Prosus wants to keep its Naspers stake below 50% for now, it's only guaranteeing to allow a minimum of 45.4% of each shareholder's holding to be converted. Of course, if less shareholders tender what they have or what they own, then those who tender all of their shareholding will get a much higher percentage that they can convert. And it seems to make a lot of sense. As a result of this deal, Naspers' shareholding in Prosus will fall from 73% to 57%. This will double the free float of Prosus shares, which is important because it elevates the stock into the top 20 of the main Euro Stocks index, and thus makes it a must-buy for many index tracking funds. The opposite occurs with Naspers, whose share of the main JSE index will fall from 23% to 14% itself. Not a bad thing. The major issue for Prosus Naspers is the huge discount at which the stock trades relative to the market value of their major asset, which is 31% ownership of Hong Kong-based internet giant Tencent. Because it's listed in Europe, Prosus trades at a smaller discount to the value of this Tencent stake than does SA-listed Naspers, and that gap is widening. For instance, in the past year, Prosus shares rose 50%, while Naspers gained a relatively modest 30%. Naspers individual shareholders who opt to swap will be liable for capital gains tax. For those who've owned the shares for a long time, that will cost the equivalent of a fifth of the value of what they're actually swapping. There's no such tax applicable for savings institutions like mutual funds. Here's an outline of this morning's telecon, starting off with Bob's unpacking of what the deal really means.
So under the deal, Prosus would acquire 45.4% of the issued Naspers and shares, and that would take its total interest in Naspers to 49.5%. And what it does is significantly increase the free float of Prosus, and that will obviously give it a good boost in trading dynamics going forward. But importantly, due to the nature of the cross-holding that we're creating, the transaction basically more than doubles the Prosus free float's economic interest in the group's underlying businesses to around 60% from where it is today at 27%. We expect that the value of the free float will rise to more than $100 billion, and this will take Prosus straight into the top 20 of the Euro Stoxx 50 index. And we also believe that the increased liquidity, the improved market index weightings for Prosus, and the enhanced trading dynamics will be value creating for both Prosus and Naspers shareholders. We believe the transaction that we've announced today will create immediate value for Naspers and Prosus shareholders. But it will also extend Prosus' standing as Europe's largest internet company, which will be value creating over the long term.
So there you have it, Piet. Any clearer?
Look, I understand what they're trying to do. They're trying to get a big weight index, so the index funds have to buy them and thereby push up the share price. I'm not sure that's management's job to do that, though. I think management's job is to run the business, allocate capital properly, and I think that's one of the reasons why the discount is where it is because they've been selling their best asset over the years and investing it in assets which are less good. So that's the one thing, and the structure they've created with Prosus, Naspers, they still have a control structure in place. There'll always be a discount for that. And at the end of the day, the market has voted. They've said, you've gone to all this trouble over the past 2 years, and the discount has just gotten bigger. There's a simple answer to this, but I'm not sure it's one that they are even contemplating at this point.
It was interesting. Nobody asked the question, but spontaneously, Bob van Dijk explained why they want to keep Tencent, because Tencent is a valuable partner and they learn a lot from Tencent, etc. So it was a little better than last time when I asked him about the unbundling, where he'd obviously prepared for it. But what is interesting here as well, which didn't really come out in that as clearly as it should have, they've got a $5 billion share buyback program. They've put aside another $5 billion to stabilize the share prices between Naspers and Prosus during this whole issue. So they're going to be, apart from what they're buying back with that $5 billion that they'd already approved, today effectively announced another $5 billion Rand share buyback program, and yet the share price of Naspers went down.
I think the market is, and we're not shareholders, so I haven't got a horse in this race. But the market is voting with its feet, and that's very clear. That's the only thing I can observe from where I sit.
Well, we're going back to the Ascendis story now, Piet, with Harry Smit, who is a activist shareholder. Justin, you've been in touch with Harry. He's on the line. Why did you ask him to join us tonight?
So the Ascendis activist group, they've all got together. I think they've got 25 to 30% stake in the business, all the individuals combined. They've been pushing the group, not for business rescue, as I think all shareholders had. And yeah, Harry, what did you make of today's presentation by Mark Sadi? He was just on the show. It was upbeat, a lot better than the worst case scenario, which was business rescue.
Yeah, Justin. Obviously, we would never be able to satisfy everybody. As you mentioned yourself now, business rescue was a very bad idea, even though we do think that it wouldn't have resulted in zero value to shareholders. We do feel the deal on the table is a much better transaction than business rescue, and obviously we would be supporting the vote that is on the table at the moment.
How did you get involved in the first place? Are you a long-term shareholder, or did you see an opportunity?
No, we are long-term shareholders. Most of the group are long-term shareholders. There are some 20%, 25% of the group that joined afterwards, but most of us have been actively involved in Ascendis for the past 18 months.
So the frustration must be incredibly high, given the way that the share price has been reacting and the problems that to overcome the engagement with the bankers.
I think the frustration is underrated at this stage, especially taking what the analysts in the newspapers and everybody who's been chucking at our side all the time. We always knew we had a good business, as Mark said, good business with good operations, good value. We basically had a debt problem, a balance sheet problem that needed to be solved. And I think Mark has done a phenomenal job since he's come on board 18 months ago to solve the issues that has been there. And the difference between us and a normal activist group is where everybody always thought we're just fighting for governance and we're fighting for these issues. We're actually fighting for value for shareholders, for a proudly South African company. We've got a 51% BE stake in Ascendis at the moment. To us, it was a South African company, South African jobs, South African pension funds, everything on the line. And that is what we were fighting for at the end of the day.
Well, Piet Viljoen tends to agree with you, Piet, that Mark Sardi's done a good job.
Yeah, no, he's done a good job. There's, the alternative is just bad for shareholders. I'm not sure what an activist group could have achieved here, because when you fight against the debt guys who are in control, you haven't got good cards to play. But I think Mark's done a good job, and if the activist shareholders had played a role in supporting him to achieve this outcome, then very well done to them.
But it's interesting, when people raise their voices, no matter what sphere of life it's in, it does make a difference. And surely, Harry, what you guys have done has at least made certain people who might have acted differently have a little pause. So do you see this as a victory for the activist grouping?
I strongly believe it's a victory. I strongly believe the amount of attention that we've got on the deal and the amount of scrutiny we've got on the deal. I mean, the fight isn't over. I mean, we've reported this to the FSCA, to the JSE, because there's been some share manipulation. There's no doubt about that. I do think Blantyre, being the stealth operation that they are and the way that they operate, they would have tried to do a sneaky. And I think with the scrutiny that we've put on top of this deal, might have put a pause on the operation and said, look, we're probably not going to get away with exactly what we want, because we've got all these eyes on us now. So we ended up with a better deal at the end of the day, according to me. And our fight is not over. The fact that we have aggregated all the support, which is growing daily, I must say. The last count was about 137 million shares in the group. I mean, our fight is not over. I mean, we're taking this to board level. We want to get board representation. We want to see if we can change the memorandum of incorporation to make the category 1 transactions smaller, take some power away from the board, get shareholders to have more of a say. And at the end of the day, I don't think any other group has got a direct line to the CEO of any company, like Naspers or Prosus or anything. And I must say there, Mark has really come to the table when our numbers grew, and I can send him a WhatsApp, I can give him a call, I can do anything like that, and he's available and he gives answers to the shareholders, and that gets a lot of the frustration and everything off everybody's shoulders.
It's a fantastic initiative. In many ways, people have been trying to get shareholders together to at least attend AGMs. You can go to an AGM of a major corporate with thousands of shareholders, and you're lucky to get a handful of shareholders actually pitching up. So what you've done, Harry, might well have made Mark think differently, and certainly he has been engaging with you. But better than this, other companies, Piet, if you get this kind of activism from shareholders, which is something, shareholder democratization, which capitalism is supposedly built on, but never really been implemented, it can only be a good thing.
Yeah, well, yeah, I would agree with the qualification. And sometimes, and I'm not saying Ascendis is one of them, but sometimes transactions and negotiations have to happen out of the public sphere to achieve the right outcome, because if it starts getting emotional, people do strange things. So I would caveat this triumph of shareholder democracy with that observation that sometimes, not in all cases, but sometimes you need to take it to one side. You need to get rid of the heat. You need to get rid of the emotion, and you need to trust the management of the board, who you as a shareholder voted to do the right deal for you. So you need to judge each case on its own merits. I think the outcome for Ascendis shareholders is good, as I said. I'm not sure it would have been very different if the activist shareholders had not been involved. I don't know. But if they were able to swing something in this direction, then I take my hat off to them. They've done a fantastic job for shareholders.
Harry Smit is the leader or spokesperson for the Ascendis activist shareholders. And Justin Roberts has been following the story. It's a good one, Justin. I mean, sentimentally, we're all on their side.
Exactly. And Alec, does this not set a precedent if something similar has to happen within a listed organization for the future? It sets a positive precedent. The activists are doing so many good things, and I just love the story.
So much money is spent by companies to try and get the media on their side, soft soaping the media, putting advertising in newspapers, financial reports, etc., because they want to influence the court of public opinion. And now suddenly you've got people who have a financial interest in those businesses who also want to hear or have their voices said. So the democratization of shareholding is something very big. I can see Piet's chewing at chomping at the lips to take us on here.
No, I don't want to take you on. I think it's a good thing. But activism, one also has to be very cautious. When you're an activist and you're fighting a company to achieve some sort of outcome, that company is fighting you with your own money. Its legal bills are being paid by the shareholders. Its consulting bills are being paid by the shareholders. Whereas you're fighting them with your own money, and they're fighting you with your own money. So sometimes it's not a fair fight either. And sometimes it can end up in the wrong place. So I'm just saying one should treat each case on its own merits.
Piet Viljoen, our guest co-host tonight. You also heard from Justin Roberts, who's going to bring the program to a close in a moment with the final market report. But before that, BrightRock believes that with every change in life comes opportunity, and the markets aren't any different. The daily movements in the markets mean change for us all, sometimes small, sometimes big. This daily market report is made just for you by BrightRock, the first ever needs-matched life insurance that changes as your life changes.
JSE All Share Index was up at 67,400. The still up 5% to 142 Rand a share as people start gearing up for the weekend on Hump Day. Prosus up 2.6%, while Naspers was down 1.6% as the index heavyweights announced further corporate action. MultiChoice lost 6% to 120 Rand a share. In the currency markets, the Rand was flat against all the major currencies to 14 Rand and 5 cents to the dollar, 19 Rand 81 cents to the pound, and 16 Rand and 97 cents to the euro. Gold is low at $1,824 an ounce. Brent crude is up at $70 a barrel. And the premier cryptocurrency will put you back 780,000 Rand a Bitcoin.
And right now in the US, the NASDAQ composite is down 2.25%. The Dow's having another tough day, down 1.25%. And the S&P 500 down 1.5%. And this market report was made just for you by BrightRock, the first ever needs-matched life insurance that changes as your life changes. We'll be back again tomorrow, same time, same place at 5:30. Till then, from the team here at BizNews, cheerio. You've been listening to the Power Hour, brought to you by the team at BizNews. Piet, that was great. I'm not so sure I agree with you on shareholder activism. I know Charlie and Warren have got a very rational approach towards it, but for too long, guys have been getting away with murder.
Yeah, so that's why I say you have to treat each case on its own merit. Sometimes you have to do it. You have no choice. And I've been involved in some of those cases, and sometimes it works, sometimes it doesn't, but you have to do it. You've got no choice. But sometimes, remember, and it's a very important point, the companies fight you with your money. They appoint expensive lawyers and expensive consultants with your money, and they don't care how long it takes. They'll fight you down to the wire with your money.
So,
in that process, you can destroy value. Yes.
Do you follow Bill Ackman, US hedge fund manager?
I do follow Bill. Yeah.
He's been very successful. I mean, as an activist investor, I know he takes board seats, etc.
He's had mixed success. He took on Herbalife and lost in a big way.
Yeah, no, he did that as well. He also shorted the credit market in the middle, just before COVID.
Yeah. So the thing is, and that's where I agree with Charlie. Sometimes life's too short to get involved with that thing. The saying I always use is, never fight a pig because you both get dirty and the pig likes it.
Oh boy, isn't that a good one? Yeah, never mud wrestle with a pig.
Yeah, exactly.
Because you'll get down to their level.
Yeah, you both get dirty and the pig loves it. So,
that is such sage and good advice. But on the other hand, when retail investors see something they don't like, they should speak up. And I love this. I'm so glad you followed this story, Justin. It's a goodie. And Justin picks these up on Twitter all the time where people get irritated.
And sorry, Piet, if I can just ask you the questions that I asked Mark, because I was just I was thinking of investing in Ascendis today. So this is why I need these questions answered, because I can't answer them myself. The percentage of RSA, so the respiratory care Africa percentage to normalized EBITDA, because I know some of those digits would be distorted because of COVID, to the medical devices, and then the net debt that remains if the pharma leader deal falls through, or worst case scenario.
So the numbers that I have is that normalized EBITDA for what remains, for what, after they sold everything and RCA is gone and all the other stuff is gone, without the upside from formally. I don't know if there'll be upside, I doubt it, but without that, it's probably about 300 million rands with the EBITDA, and that's probably optimistic. It's around about 300 million EBITDA. But they've got a heavy head office. They've got a head office which costs like 150 million or something, which I assume they'll cut those costs. So if you take, let's say, half the head office, so 300 minus 70 leaves you with EBITDA of 230. Put that on 5 multiple is about 1.1 billion. Their debt is going to be, I think, the 220, which you mentioned, plus more, because when a company is in this position, it's probably extended its creditors by a long way. So it'll need to draw on those lines to pay its creditors and get up to date and bring in new stock to these businesses. So I think you take 400 million as a debt off, and you'll end up with about 800 to 900 million rands worth of equity, and the current market cap is 500. So I think there's still upside if those numbers are right, but those are guesstimates. They're very broad guesstimates.
And then you've still got 3 good businesses, or 3 all right businesses in medical devices, consumer brands, and pharma.
And the key here is I think those businesses will be sold within 18 months because they're worth a lot more in somebody else's hands. Because you cut the costs, you cut the head office costs out, that value just falls down to the bottom line. So I think those businesses will be sold, taken private, most likely in the next 18 months. That's my guess.
Thanks, Piet.
That's a very interesting. Are they the guys along the Western Bypass? They've got that big building. There's quite a big, or is it up here in Bryanston? Bryanston. Okay. It's an expensive building.
Yes. So something I don't understand. Sorry, just one more question. Head office costs, what does that consist of altogether?
That's Mark Sardi's salary and everybody else there and sitting in the head office there along that road that you mentioned.
So it's just salary and wages.
It's OPEX. It's basically operational costs. And remember, this used to be they're selling off bits and pieces, and now they're selling off a huge chunk of it. But the head office costs aren't going with is not going with Remedica. It's still sitting there in that office building.
A little bit like what Anglo Coal is going to be looking at with the head office costs from Anglo American being taken off. I mean, those are tens of millions of dollars.
Yeah, so they'll look pretty good coming out of that. They'll be able to cut costs quite a lot, I think. I hope for their sake.
Have you done your work on that yet, Piet? On the
No, I haven't.
new angle?
I haven't yet.
Okay, so
but I will be. I will be. I will be. I think it's one worth doing some work on.
Because Neil Freineman was saying to us that he wishes he was younger so that he could run a business like that. So
I think that's a cash generator. I mean, if you look at Xaro's coal business, it just prints cash.
And Alec and Shapiro were saying that have far more experience. They've seen these kind of spin-offs in the past. Do you think you'll see forced selling from the internationals and then maybe 2 weeks later get a better price?
So one of the strategies, apart from buying these debt-laden good businesses like Avenge and Ascendis and PPC and those sort of things, another thing I do in the fund is I buy spin-offs. I just buy like MultiChoice and all these things that get spun off, because the first thing when Naspers spins off something like MultiChoice, the international shareholders say, "What is this? I don't want this." They sell it. So the first reaction is sell it, and you'll definitely see that happening in Anglo Coal, and it'll be accentuated because a lot of shareholders say, "Coal, that's a dirty thing. I don't want that. I just want." They don't care what the price, what the value is. They'll just sell it. So spin-offs is a very good source of uncorrelated return.
Fantastic. Well, thank you. We now know. What are we going to put in the portfolio, hey, Justin?
Exactly.
And it's always great talking with you, and look forward to next week.
Yeah, thank you.
Cool, man.
Cheers, Justin.
Cheers, Piet. Go on.
Bye then.
Bye-bye.